Welcome to Profile Traders, and this is a short video presentation covering stop losses. So let's look at the definition of what a stop loss is. A stop loss is a limit order that you place above or below your trade entry in order to limit your losses in case of an adverse market move. That means, let's say you buy something at 10, you put a stop loss at 8. In case you're wrong and market drops by 2 points and hits that 8, you are out of that trade and you limit your losses to 2 points. So if you are long or if you bought, basically you will use a sell stop. If you are short, you will use a buy stop to protect the trade. However, you must understand that during a fast moving market, there is no guarantee that your stop order will be executed at the exact limit price that you set, but rather it will be filled at the best market price. Coming back to our example, let's say you have bought at 10 and you have a stop loss at 8, and all of a sudden market moves very fast through your 8. Doesn't necessarily mean that you will be filled at 8, because as the market is moving fast, if there hasn't been enough orders to fill you, then there is a chance that you will be filled at market. That could be 7.5, 7, depending on how dramatic the situation has been. Therefore, your losses will be greater than the 2 points that you have anticipated. So always keep in mind that when you are using stop losses, there is no guarantee whatsoever that your losses will be limited to the amount that you have set by placing your stop loss order. Now, second topic, styles of stops. What we will do here, we will cover all different type of stops that are available out there. Dollar stop to start with. Dollar stops are orders that you place to limit your losses to a specific dollar amount. This type of stops is the most commonly used because it provides a false sense of security. Let me read through it and then I will explain. The fact you only risk a specific dollar amount makes the trader feel safe. However, if the dollar stop amount is too small, the probability of getting hit by random market volatility is quite high. As a result, one can get stopped frequently using tight stops, only to see the initial trade strategy being perfectly right. So a dollar stop is basically a stop that you place based on your wallet. Example, let's say I buy an E-mini contract at a specific price and I tell myself that the maximum amount I want to risk is $200. Therefore, I'll go ahead and place a stop order against my trade that would get me out of the trade if I'm wrong by $200. Now, the $200 that seems fine for you may not be relevant to the market. Maybe the $200 that is fine for you is too tight or too small of a amount for the volatility at the time where you are putting it in, and as a result you feel that you are safe because maximum you will lose is $200 if you are not caught into a fast moving market. And due to the volatility of the market, you can then easily get hit with your stop, lose $200, and only to see the market going in your direction after you got stopped. So that's why I say it gives you a false sense of security, because the security that you provide yourself is a specific dollar amount that you're willing to lose. However, the placement of that stop is not market based. It's based on you deciding the dollar amount you're willing to lose. So what happens in majority of the cases in the long term, when you use dollar stops, you get stopped out more often because of market volatility rather than you being wrong on your trade decision. Therefore, I believe dollar stops in the long run will provide you a false sense of security, but will cost you much more money by seeing your stops getting hit because it's too tight and you set it based on a dollar amount and not based on the market structure, and you will lose more money to this kind of stops that you would be losing to the market because of your bad judgment. Next type of stop, time stop. This is not very commonly used, but it's still used by some. And basically what it is that you enter the market and you give it a specific time to be right on your trade. So let's say you enter a buy order, you give it a 5 minutes time to go your way. If it doesn't go your way after 5 minutes, the trade is closed. I do not use that kind of stop, but as a trader, it's good that you know your products and what is available out there, and time stop is one of them. Next type of stop, mental stop. Mental stop is oftentimes used, and it's a stop that you will keep in your brain. For example, if I buy at 20 and I tell myself I'm not going to put any physical stop order into the system, however, if price comes down to 17, I personally will close the trade. The danger with this type of stop is that you will inject human hesitation, you will inject into it human fear, you will inject into it human hope. By that I mean that maybe when price gets to 17, since you do not have a physical order out there that will take you out, you have to press the button, and at that time you start to double question your initial plan to exit at 17. Then you start to hope, maybe I should hold a little bit longer, it's gonna go back. Maybe I'm not sure I can pull the trigger now at 17 and exit. Hesitation. You add to that fear. If I now exit at 17, maybe the loss that I'm gonna take is unnecessary and it's gonna go back up and I'll be fine. So you inject fear and then you inject hope. So you have to be extremely disciplined. If you use mental stop, be like a machine. If your level is hit, you have to exit your trade based on what you told yourself you would do, and not let human sentiments and feelings get involved and sabotage pretty much your initial trade idea or stop strategy idea. Next type of stops, structure stop, which in my opinion they are by far the best. This is a protective style of stop that you place based on the structure of the market, dictated solely by charts, based on established supports and resistance level. In our opinion, this type of stop is the best because the stop is positioned independent of predefined dollar amount set by the trader, but rather it's a stop that you place based on defined levels given to you by the charts. This type of stop is not commonly used because the range of the stop may be too wide based on the structure of the market, and that could be a point of discomfort to the trader. However, the structure stops will provide you the best probability not to get stopped by the market noise and remain in the initial trade plan. So now let's review this. What is the structure stop providing you is based on already established support resistance levels. You would use those critical support resistance level to place your stop. So let's say the previous significant low that we had in the market was 15, and now the market is at 20. For whatever reason you decide to buy it at 20 because you think it's going to go higher. Structure stop is telling you since the previous significant low was at 15, your stop should be somewhere below that 15. Now you're going to tell yourself 20 minus 15 is 5 points. It's too wide for me. The too wide shouldn't matter. What should matter are two things. Number one, that level was a structured pivot point set by the market, and for the market to come down and break that level again, if it's in an up move, they're not going to do it because they will have to spend a lot of unnecessary money to bring it down, break 15 and get the stops out. Therefore, your chances are the best that even if the range of the stop is wide, that you will remain in your trade without getting stopped out. That's what you should be concerned with. Finding levels that have the least probability of getting hit by market noise. If you do so, even though that you will be using larger and wider stops, your chances and your probability of remaining in your initial trade until your trade plan is accomplished and your objective is reached is the highest. And that's what's the most important. You want to stay in the game, not getting stopped out and lose money for no reason, only to see your trade to be totally right. And this, the structure stop, will provide you the best opportunity to remain in the trade. Again, what makes that happen is the fact that for market manipulators to come and hit a level that is too close to your entry and stop you out is much easier than for them to come down and break a significant structure stop, because they will have to spend a lot of money to bring the market to that level, knowing that after that it should continue, let's say in this case, to the upside. But for them to come and hit the stops that are very nearby, let's say 20, is much easier than for them to bring the market down to 15 and clean up the stops. So this is a without a doubt best type of stops to use. But in order to use them correctly and in the right way, you need to be able to learn, read charts, understand charts, pinpoint support resistance level that are structurally key in a correct way, and then use them appropriately. Next topic, rules of trailing stops. Each trade has two components to it. Number one, the trade idea. The trade idea is the strategic tool and reason behind initiating the trade. It is directly related to the trader's market knowledge and motivation to open a trade. So your trade idea is basically based on your knowledge, and it's based on whatever reason, based on your analysis that provided you the logic to go ahead and place a buy order or a sell order. After that, once your trade idea is established, comes point number two, which is equally important as your trade idea, which is the trade management. Trade management starts immediately after your trade is initiated. Managing the trade efficiently is as important as the trade idea, because you can have the right trade idea, but if you manage the trade poorly, you still can lose, or you can just marginally benefit from your full trade potential. And the reason why trade management most oftentimes fail because is due to the fact that you do not have the right trailing stop. And if you incorporate the right trailing stop into effect, your trade management will become much more successful. As a result, if you trail your stop too early or too tight, market noise will stop you, and that will happen before your trade target is reached. And if you are not able to benefit from good moves where you capitalize greatly on the trade by benefiting from the whole range of your target, and you only make little by little, that's not good, because the time that you're going to lose a little bit more than how much you made little by little, you're in the hole. So make sure that you manage the trade correctly, and the way to manage the trade correctly is by having the right trailing stop strategy. Now, what is the correct way of trailing stop? Again, let's look at the details. Each trade has three elements to it: trade entry, trade target, trade stop. Trade entry is based on technical reasons supporting our decision to initiate a trade at a specific price. Pretty simple and straightforward. Trade target consists of the amount of ticks we anticipate the trade to reach and yield a profit. So if I enter at 10 and my trade target is at 15, I have a 5 points target for my trade to reach. Trade stop is the tool that we use to limit our losses in case we are wrong, and the various stops that we can use has already been covered. So now, what's the correct way of trailing stops? Once again, mismanaged stop strategy can be as great of a cause of losing money as the wrong market understanding would be. The wrong stop placement, the wrong trailing strategy can all cause you lose money on a perfectly fine trade idea. So the question becomes, what would be the right stop strategy be? That should be a strategy that would protect us from excessive losses and at the same time allow our trade idea to reach its maximum potential. This is our rule for stops. Number one, use market structure to identify your stop location. Structure means purely and simply the chart, not your comfort dollar amount, not a random amount of points, none of that. If the structure is 7 points, the structure is 7 points. Very sorry if it's putting you into a discomfort, but understand that you should get the best probability in remaining and not getting stopped in your trade by using this wise structure stop. Stop location should be far enough from current market price so it would not be easily reached by market manipulators. How would a market manipulator benefit from stopping you out? Very simple. If I'm a big guy and I want to accumulate a line of X amount of contract, obviously the cheaper I get my contracts, the better off I am. So what if, due to my experience and my knowledge and other tools that I would have, I know that, for example, a big chunk of people went long at 20 or bought at 20. And I also know that commonly most of people would use a 2 points or a 3 point stop. Therefore, what I need to do is to spend a little amount, a little dollar, to start to sell. As I start to sell, I bring price down, and I know that once I'm gonna hit either the 18 or the 17, where a lot of stops would be sitting, I would have them triggered. As the stops get triggered, markets would drop fast because of all the stops coming and being executed at the market. And as it drops fast based on the fact that I have triggered them, I go ahead and buy them all. Now I have accumulated a whole bunch of contracts much cheaper than the $20 where the market was at. Once I'm done with accumulating everything that was triggered on the sell side by the stops and there is no more stops to sell, I start to buy again, and lack of selling orders triggered by the stops which are already out, market starts to go up and I'm in it at a much cheaper price. Now, if it happened that you were nearby where these criminals were able to manipulate it and bring it down and hit the stops and at the same time buy into it, guess what? You lost money only to see the market turning around and going in the direction that you were initially expected to go. So be careful. It happens every single day in all markets. If your stop is too close to where they can come and get it, they will come and get it. I can assure you, I can guarantee you. Therefore, look for structure stops and structure level based on technical analysis and find them, use them, because they will provide the best probability to remain in the trade until your trade target is reached. If the width of the structure stop is too wide for you or your comfort zone, in my opinion, don't worry about thinking already losing. Do not enter a trade with the initial immediate idea that you think you're gonna lose. Don't bring bad energy and bad mental force against your trade but rather think, I'm entering this trade, I want to find the best and the most secure level to enter my stop so that at the end I'm a winner. Not, I'm entering this trade, my God, I'm gonna lose. This structure stop is 7 points. My God, if I do that, I'm gonna lose $7 guaranteed. For sure, I'm gonna lose. If you set yourself up to lose, you will lose. Why? Because your brain will act as you're directing it to act, and you're telling your brain that you want to lose and you're prepared to lose, and your brain will find all the excuses necessary to make you lose. So how wide it is, not to worry. Think about it as a sound strategy. However, don't believe that I'm telling you every time you will use a structure stop, you will never lose. No, you will lose. At times, even a structure stop will get affected if the market is influenced, or if the market is all of a sudden affected by an outside news that you did not expect. It's going to go and go through all structure stop that could be nearby. But in average and in the long run, your tight stop, your dollar stop that is not structure based will get hit much more often than a structure stop will. Before you initiate your trade, calculate the amount of ticks you are projecting to gain from your trade and write that range on a paper. So if you buy at 20 and you expect the trade go to 25, that's 5 points range. Always have that in mind. Why? We will see why. The right tool or the right way of trading stop, according to me, is once your trade is initiated and your structure stop is in place, you do not touch that stop until 50% of your profit range is reached. So if your profit range has been 5 points, after 2.5 points in your favor, only then you bring your stop at break even. Before that, if it goes against you, if it goes less than 50% of your range, you do not mess or touch the stop. Once your profit target is reached by 75%, then you trail your stop to 50% of your projected profit range. That in this case, it means if you had 5 points target and now it's passed and it reached 75% of your 5 points, then your trailing stop moves to 2.5 points from your entry. At that point, you do not touch anymore the stop until either you are stopped out, in which case you will capitalize and cash in 50% of your profit target, or it will stop you out, or it will go to your final profit target. This, I believe, it's the most sound stop strategy. Look into it, give it a try. Just wanted to share the idea with you. Thank you very much for listening, and all the best in your trading journey. This was Reza with Profile Traders.